10 o'clock, but everything. But I'll just, I don't have any.
Thank you, Katie. Thanks everyone who came to the director's cut and also those who logged in. Hear what we have to say. Steady. This is what we were expecting in November. So preliminary production, and of course there will be adjustments, but our November production just filed. It's down just 6,500 barrels a day from October, which is essentially no change at all. Interestingly enough, I got a note from Justin this morning, and I was wondering what the impact of winter finally arriving would be. Surprisingly, to many of you, it's hurricane season in North Dakota, and so we just kind of do it on the opposite of what the rest of the world does. So the high winds and predominantly the high winds, as we know, you can't hydraulic fracture wells. You can't do workovers on wells. Drilling rigs are a problem. Mostly they just circulate because trying to move pipe in and out of a well is an issue. But of course, there were electrical outages and those sorts of things. So the estimate is that this storm may have knocked 50,000 to 75,000 barrels a day offline. So again, looking at completion numbers in December, I'll talk about that in a minute. And then winter finally arriving in mid-January, we're probably going to see some downward trend in production. And I think you're going to see the legislature try to build that into their first half of the session forecast to trim a little bit on the production. On the other hand, prices are significantly better. So we've seen a $6 a barrel increase in North Dakota Light Sweet, and West Texas Intermediate is up about $5 a barrel, a little over $5 a barrel. So we are very solidly into the territory where fracking duck wells is economic. Unfortunately, it's hitting right as winter reaches its worst. And so it's going to be counteracted by the winter weather, the need to heat water, all the logistics that go into that. So I'm not expecting, as a result of this better price, a big surge in duck well completions. We stimulated that with CARES Act money in November and December. And our best count is that we've dropped now half the frac crews. We thought we were at 8 or 9 approximately in December. In November, and we're back down to 3 or 4, and probably anticipating only 1 or 2 in February. You can see that showing up in the completion numbers. If you look at the bottom of page 1 there, our preliminary numbers show only 4. Whoops, I did not change the months there, so I apologize for that. That's the December completions. So November was a good month, 74. December, so we'll get that corrected. I'm not sure how we missed that, but so November was a good month, 74 completions. December was the 44 completions. As you know, we've had Justin do the analysis on this. We need 60 to 70 completions, new wells coming on in a month if we want to maintain 1.2 million a day. So that would tell you that beginning in December, due to reduced completion activity, and now with winter coming and ongoing reduced completion activity, we would expect some slight decline, gradual decline in our production. Not, you know, it's not like we're not completing any wells, but we're completing over half of what we need. But we're not at a point where we can maintain the 1.23 million barrels a day. So I apologize for that, and I'll make a note to get those corrected numbers out, but it was December. So when you look at it, the CARES Act money went to 40 completions in November and 40 in December. In the absence of the CARES Act money, we would have had little to no completion activity in December. The price is helping. Winter weather is pushing us the other direction, and you can see that in the drilling rig count too. 11 is the count today, and so companies who are not engaged in a lot of federal land activity, such as Fort Berthold or Forest Service drilling, have backed off 2 rigs, and so it's only those who have significant federal holdings that are really maintaining or adding rigs. So we've gone from 14 rigs down to 11, and 6 of those are on federal lands. 5 are on Fort Berthold, and 1 is on federal surface outside Fort Berthold. So ongoing concern about upcoming limits, moratoriums on permitting and hydraulic fracturing coming from a Biden administration. And that's something I want to talk about. So when we turn to Fort Berthold in particular, down 2 rigs on Fort Berthold, but oil production's up 5,500, and that's really where the duck wells were completed. All of them were on Fort Berthold. And so the concern is that there are 2,900 approximately, it's actually 2,893 future well slots on trust lands on Fort Berthold. And so the concern is, what will a very activist, Green New Deal Interior Secretary do with those 2,893 drilling slots? We anticipate a negative impact on that, but we can't really quantify it as to the timing or how that might play out. So that's one of our watch list things. One of our watch list items is that 2,893 wells on trust lands on Fort Berthold. Also, it's the best rock in the Bakken and Three Forks. So it has the best geology. It's got the most Three Forks layers. So it's very important that ultimately that resource gets developed, not just for Fort Berthold and the MHA Nation, but also for the state of North Dakota and the nation. Turning to OPEC, they did add 500,000 barrels a day in January, and then they added 50,000 and said they were going to take away 1 million going forward in February. So the 50,000 will come from Russia and Kazakhstan. The minus up to 1 million will come from Saudi Arabia. And so general consensus from the 2 big players there, Russia and Saudi Arabia, is that the ideal price band is between 45 and 55. That is high enough that duck wells in North America, in the United States, get completed, but it is not high enough for substantial increases in drilling rigs. That happens at that $55 to $60 range. So that's the tightrope that they're walking, and that's the tightrope that they plan to walk with monthly meetings going forward. Typically, they would just meet quarterly, but they're going to meet monthly to talk about adjustments in OPEC production. The 2 big uncertainties there, and I've listed them, are COVID. How quickly does world demand return? We're still down like 38% in terms of jet fuel demand. Distillate demand, diesel and distillates, has recovered. It's back to 2019 levels, and that's because we don't have an alternative. That's how goods move across the country. That's how construction happens. That's how agriculture does its business. So distillate demand has recovered. Gasoline is still off 5 to 10%. So it's the jet fuel area that really is struggling. And so wasn't there a movie, Planes, Trains, and Automobiles? Yeah, we could do it. We could do some takeoff on that. And planes is down 35 to 40%. Trains is back, and automobiles is off 5 to 10. So I don't think we can get the main actor back though from that movie. Nope, he's gone, unfortunately. One of my favorite comedians of all time. I'll finish up with a couple of items. No change in gas capture, hung right in there at 93%. In fact, pretty much the same all across the board, continuing to struggle because of right-of-way and just the slower process on trust lands on Fort Berthold. But even that's at 89%. If we could just get that up 2%, we would be in total compliance everywhere. And so that's really a focus area. Also, I want to extend congratulations to Outrigger. Their 250 million a day plant, an 80-mile gathering pipeline. It's a 20 to 24-inch pipeline in west of Williston up there. The Sanderson plant is going online. So they pushed through with the construction, even with the COVID pandemic. There is a significant bottleneck in terms of gas gathering and processing north of Lake Sakakawea. South of Lake Sakakawea has surplus capacity and things are pretty good with the exception of the really rough Badlands area in northern Dunn County. But north of Lake Sakakawea, it's bottlenecked, and so this is going to really help. In particular, their main customer, XTO, formed two big units in Hoffland and Grinnell last year, and so or late 2019. And the development of those units was dependent on this project. So they now have the gas gathering in place to move forward. If you're kind of wondering where those are, northeast of Lewis and Clark State Park, okay, but between there and Hoffland Bay or Red Mike. I don't know if you're a golfer or a fisherman or if you just like to go to state parks, but that kind of puts you in. It's between Lewis and Clark State Park and Red Mike in that area. So that's great news, and congratulations to Outrigger. So the infrastructure continues to move forward. Justin can maybe give you a little more detail on this, but I think there are 4 additional plants that were 3 that were postponed from 2020 construction and startup to this year or early next year. So there is infrastructure in the pipeline to keep up with this on the gas capture side. And then finally, the last few pages, I think it's about 5 pages of ongoing litigation, 2 cases with BLM. These are all in the circuit courts or trying to make their way to the U.S. Supreme Court, and one with EPA. Just a comment, I think it's anticipated that activity will pick up with a new administration, and that there might be more to watch there. So that's my comments. My apologies for the error there on the completion, so we'll get that corrected.
Any questions for Lynn?
Yeah, that's a good segue into something I just wanted to ask you about. I've been thinking a lot lately about Dakota Access and the fact that 4 years ago, we saw the Obama administration step in and intervene in that case. And then, as soon as President Trump took office, he intervened in that case. We have a new presidential administration. How concerned are you about the possibility that Biden could do something here to influence things?
Yeah, so the question was Dakota Access Pipeline in the new administration and the level of concern. And I would say the anxiety level is pretty high. I think on the positive side, it's far enough along in the court system that's going to play out before there would be anything happen with the Corps of Engineers that might result in a total shutdown. So I don't think you're looking at an overnight situation, but the anxiety level over Dakota Access is pretty high when we look at oil prices, and you would potentially look at $5+ a barrel additional transportation cost. That moves us back out of the territory of completing duct wells. So we're at a tipping point, really, where we've just reached the economics, and here in about 2 months, we'll reach the weather window when duct well completions just make a lot of sense, and it would be a big blow to lose that $5 a barrel. So the anxiety level's fairly high, but it's not going to be an immediate thing. It's in the court system. I believe it's in the DC circuit.
Well, given the, as you mentioned, the forecast that the two appropriations committees have now adopted, the plan is to, their forecast is to go from 1.2 to 1.1 for the remainder of the biennium, million barrels, and then for the next biennium, 1.1 to 1. Is that reasonable?
Yeah, so the question was the newly adopted revenue forecast going from 1.2 declining to 1.1 by the middle of this year, holding at 1.1 for the first year of the biennium, and then a million a day for the second year of the biennium. It's very reasonable. It's not unrealistic at all. I think it's a little conservative, that second year of the biennium, but there'll be an opportunity to look at what happens between now and the first week of March and see if maybe some upside starts appearing there. But when you look at these completion numbers that we're seeing and the rig count and the oil price and some of these uncertainties, it's pretty reasonable to try to get on the conservative side of this production curve. Fortunately, on the other hand, I think it's about a 10 or 12% increase in price over the previous forecast. So that's being offset to some extent. So I think it's pretty reasonable when you look at these numbers.
You had mentioned that our hurricane here had knocked off 55 to 75,000 barrels per day of production. How quickly do you expect that to bounce back?
Yeah, so the question was this 50 to 75,000 barrels a day that went offline, how quickly could that be back on? And the estimate is 1 to 2 weeks. It's primarily the loss of electric power and some completion activity. It's just outside, the wind hasn't stopped blowing, so they haven't started completing wells again, but they are out there working to restore electric power. So a week or two, by the end of the month, that production should be back on. So it should show up, and we may actually even get some flush production in early February as a result of these wells being down and then being put back on. So, and not a long-lasting effect.
Additional questions? Go ahead, Adam.
Yeah, question on the dovetailing off of the revised revenue forecast and the legislative budget status. I'm looking at the latest numbers for the legislative budget and seeing that there's a number of buckets from oil tax revenue that have zeros on them now. I'm just wondering if you can say a little bit about how you're expecting this shortfall to affect the legislative budget, both in this session and the 2023 session.
Yeah, great question. So looking at the revised or the brand new revenue forecast, it's shiny new, huh? It was just approved this morning. Yeah. And then what that ends up with. So just for those who aren't familiar with it, the way the North Dakota legislature has learned to deal with these price volatility and production volatility issues is to put the oil extraction tax and the gross production tax into buckets and then spend it kind of later, in other words, but not spend it until it's in the bank. Don't plan on revenue, large amounts of revenue coming into the general fund. And you're right. So this lower forecast results in some zero buckets in there. Now, the talk that I've heard is that some of the upstream bucket, either fill rate or maximum volumes, are likely to be adjusted so that we don't end up with zeros in any of those buckets. In particular, we've been asked to provide a long-term budget for the abandoned well plugging and site restoration fund. As you know, we're going to lean on that to finish up the CARES Act projects. It's got about 26 million in it, and it's slated to get 7.5 million a year. So the question's been asked, what do you really need? Put together a budget for us that's short-term and long-term so that we can look at, could we maybe adjust the flow into that bucket so that buckets downstream actually do get some revenue. So that's the question that's been put out there. to everybody who spends out of those buckets, Water Commission and everybody else, is can you revise your stream downward a little bit so that everybody feels some pain and nobody is totally taken out.
So just to make sure that I'm understanding that correctly, in looking at the estimated oil and gas tax revenue allocations from the newly approved budget, are you saying that some of the, like from the general or tax relief or budget stabilization funds, something from those allocations might be funneled into, for instance, the airport infrastructure fund would that money going into the current zeros be coming out of buckets from the oil and tax, the oil and gas tax revenue buckets that are already filled up?
Yeah, that's my understanding of what's going to be happening now over the next week or two. So now that they've settled on a forecast and legislative council has looked at it and said, well, here's the impact of that. Now, as agencies and organizations come in front of them for their budget hearings, they're being asked to look at revisions that would maintain some flow into all those buckets. So that's my understanding of, a large part of what's going to be happening now between now and the next revenue forecast coming out. Mm-hmm.
So appropriations committees are less of appropriations committees and more of a bucket brigade.
Bucket brigade. Thank you. I'm not sure they would appreciate that, but actually, actually, it's a pretty interesting mental image. Buckets of money going down the line.
Can you give us a bit long cost prediction? I know it sounds like for the next couple of sections, not that great, but does that maybe start to turn around once
Yeah, so the question for those not in the room was a little bit longer term forecast. I've talked about, the next 3 months of winter, December, January, February production likely showing some decline. Yes, we do anticipate if Dakota Access stays in operation and OPEC is able to achieve their goal of roughly, $50 per barrel, that by March, when our weather window starts to open up, we'll start to see increased activity. Still don't anticipate us hitting a price point that adds drilling rigs probably this year. We're probably looking into 2022 before we see the kind of oil prices and the the long-term forecasts that would bring the drilling rigs back. So the plan that I'm hearing is, and you can see the waiting on completion wells there, it's down a little bit, but 710, that's a pretty good inventory. The plan is to, starting in March, burn 40 or so of those per month through the end of the year, and actually sustain, or actually maybe even, some months increase production as a result of completing duck wells. And my numbers, I think, show that out of the 710, 110 of those are in the best rock area on Fort Berthold. So, out of the 450 to 500 that they intend to complete this year, 25% of those are in the very best geology on Fort Berthold. So that's sort of the way it looks extending out, hence the revenue forecast, declining production December, January, February, stabilizing and flat to maybe a little bit up through the end of the year. And then it's that second year where the uncertainty lies. I think drilling rigs are going to start coming back, hopefully early in 2022, and we'll be able to hold production flat. Certainly by the end of calendar year 2022, we should start to see production on an incline. And I know that's not what the revenue forecast says. It actually drops down to 1 million barrels a day, but they always want to be on the conservative side of that curve.
Any last questions for Lynn? All right.
Thanks for coming.
Can you see that?
Yep.
Okay. Perfect. Well, good morning, everyone. Justin Kringstad, Director of the North Dakota Pipeline Authority. As you've just heard from Lynn, not a whole lot of movement, at least on the production side of the world. And so when you translate that to the midstream side, things are going to be fairly routine here this morning with some of the updates. Again, looking around the region at oil production, South Dakota, Eastern Montana, slightly down in both of those regions as well, and zero drilling activity in both states. So I'm not anticipating any type of growth going forward anytime soon in those two areas. On slide 3, again, you can just see, just for comparison, that month to month, again, flat for all intents and purposes for both crude oil in green as well as natural gas in red. One thing, and Lynn, this is just following up on his comments. So on the next slide 4 there, Katie there, just a little bit of history of how North Dakota's drilling has tied to oil price. And so what you're looking at is in green is WTI oil pricing. Gray is our North Dakota drilling activity or rig count. And both axes, whether you're looking at price or rig count, are synced on both sides of this chart. So if we just look back prior to the collapse between 2017 and 2020, it was a pretty fair rule of thumb. You could get away with saying that roughly rigs were tied to WTI on a 1-to-1 basis. So if you were to estimate WTI dropping $5, you could maybe assume that rig counts would start to drop by that same count. You go back to the next phase in time, you can see that there was a 2-to-1 ratio during that phase before the downturn of 15 and 16. And then you go back to prior to the downturn 2009, and it was about a 0.5 ratio. And so after each one of these downturns, whether it was 2009, 15, 16, and now in 2020, there seems to be some type of reset in how North Dakota's rig activity is tied to price. What we don't know at this point is how this is going to look now as we transition forward, right? The old rule of thumb of 1-to-1 or whatever that ratio is, what's going to be appropriate. And that's important for us on the planning side when we're looking at infrastructure and production forecasting. So that is one of those big wild cards right now. And I think we'll just have to, time will tell. You'll get 5 different answers from 5 different people on what they think that might do. But just so everyone's aware, that is certainly a high degree of uncertainty at this point. So now just transitioning on slide 5 to the more traditional look. We did see from a market share perspective a bit more crude moving by pipeline systems in the month of November, even though production was flat. So on slide 6, again, you can see in purple that rail market share did drop slightly, and we did see some more barrels moving on the pipeline network. On slide 7, so my estimate then is right around 185,000 barrels per day moving out of the region by rail car in the month of November. Slide 8, again, we saw from September to October. October is the latest on these market destinations, but stronger market share going to that Pacific Northwest, primarily the Washington State refinery. So 3/4 of all the oil in that month was going to the Pacific Northwest, and the remainder going to the East Coast. We saw zero flow to the Gulf or Cushing or some of those other markets. So it was primarily 1/4 to 3/4 east and west. What pricing was doing in October, again, it certainly makes sense when you look at what the PAD 5, so that's that blue, the northwest portion of the U.S., pricing there was advantaged compared to, say, even the Gulf or the East Coast, because that distance from North Dakota to the Pacific Northwest is shorter, that rail rate is lower, and you're able to get a more attractive price in that market. So it's not any surprise when you look at the pricing, why that was the premium destination for any of those barrels going by rail car. And where things sit today, again, we have seen some strengthening over the last number of weeks in that Gulf Coast pricing relative to Cushing. It's still a little bit weaker than the Brent market, but it has improved, as say 30, 40 cents. So we'll see. But again, those differentials between Brent WTI are still nowhere near that threshold where we really start to see folks swarming to get crude onto rail cars. Slide 11. Again, just an update on what's moving across the border. We did see an uptick in Canadian flows coming through primarily by rail car through North Dakota's ports. And then slide 12, again, this pie chart hasn't changed now for 3 months, which is good news. That is a positive sign for the industry that those investments they've made are working to get that gas captured and moved to market. And again, just that historical trend starting back in July, mid-2019, which was really when we started to see massive capacity coming online and investments that had been in the works for a number of years really start to pull down that gas flaring percentage, which we expect to continue as long as we can continue to stay ahead of that curve on the production side. More good news on the gas connections, that black line. New wells selling gas was above new wells producing gas. So again, that's another positive sign for the midstream and the gas gathering folks. And then this was updated here just earlier this week. This was that updated EIA price outlook. And one thing between now and next month in February when we meet, one big event that's going to happen is the EIA will unveil their new long-term price outlook for both Brent and WTI pricing. And so this, when you look at this graphic from 2023 forward, that is all forecasted price prior to the industry collapse, prior to COVID, was when the EIA last did their big annual update. And so we'll now see here at the beginning of February a revised look with everything that's happened over the last year. And so certainly my forecasts, some of those outlooks will start to look differently depending upon what the EIA does. And I don't have any hints at this time if it's going to get stronger, weaker, what that time frame will be. But it certainly will most likely look different than what we've been forecasting for the last year. Slide 6, again, with production fairly steady on the gas, I am continuing to expect gas production. I know Lynn was talking quite a bit about crude oil, but even when crude oil is flattish, we do still expect gas production to continue to grow just because, again, the way that the reservoirs change over time and some of the downhole chemistry. So I am anticipating that need for gas capture and processing is going to continue to ratchet upwards, even if we do see a more stagnant oil production environment. And then slide 17, again, just the same graphic, but a long-term vision. On the transmission side, I promised here a couple months ago that I would be updating every month just because this is such an important topic on the transmission of natural gas, where we're at. Roughly 75% of Northern Border, as of today, this morning, is North Dakota's gas moving on that system, and the remainder coming down from Canada. Again, when we're looking at the long-term needs and capacity constraints in the region, this was one thing we'll continue to watch and make forecasts appropriately. And then on slide 20, the BTU content. And so should Northern Border again choose this year to file a revised tariff and try to, again, address some of those heat content issues on their system, this will be an important metric for us to watch of where things are at, where they've been, and where we see them going forward. But certainly right now, had that tariff not been rejected by FERC, certainly today's BTU levels would exceed what that tariff had proposed, at least for the long term. So with that, I would be glad to answer any questions. So.
Interesting. Do you have any thoughts about what this new power plant that's going to use ethane might do in terms of flaring?
Yes. So, and thank you, Dave, for bringing that up because I failed to mention. Lynn had talked about the Sanderson plant. When we go back here, just a slide on slide 20. This BTU rising is directly connected to North Dakota's ethane content in our gas stream. And when you look at gas capture as a whole, you need to have all phases in sync. You have to have gathering, processing, transmission of natural gas liquids. All of those need to be in sync. Otherwise, the chain gets broken and you've got flaring issues. And so going forward, as our gas volumes continue to grow, as those ethane volumes continue to grow, there's a piece of that chain that has the potential of being compromised. And if we don't have solutions in place to address that ethane going forward, it will be a choke point in our total gas capture look. So having a market in state to use that ethane is going to be a critical component. Right now, folks that if they wanted to address this issue without in-state use of ethane, they would be taking a loss as they try to ship that ethane out to different marketplaces. The market is just saturated in the Gulf and in the Mid-Con with ethane, so the price just doesn't support the transport and processing. But if we can use it here in state, provide more value for it, address those generation needs in the region, that's a win-win on many fronts.
On the topic of flaring, is it this month's data that has to comply with the state's November, the flaring target that took effect in November? Is that correct?
Correct, yeah.
That's what I thought. And then, there's a couple other gas processing plants that I think plans are still in the works for them, but works have halted because of COVID. Have you been hearing anything about when work might resume on some of those, or if those are going to be still expected?
Yep. So looking at this graph on slide 16, the first step in, so that green section are plants that are planned to come online here within the next year or two. That first step is the Sanderson, so that next month will be changed to Peach. The two big projects are going to be the Bear Creek 2 by One Oak, as well as the Hess Tioga expansion, 150 million up at Tioga. So that is still moving forward. That did get delayed. One Oak, to my knowledge, is still moving forward to get the Bear Creek 2 online. So the one big unknown is that blue piece of the pie. That's the Demicks Lake 3 that was suspended. No new time frame on that one's been proposed. So at least two additional projects expected here, either this year or next, and then and a question mark on that Demicks Lake 3.
This is a matter of just information. Is the Hess plant the largest gas processing plant?
When you look, well, so it's 250 million. So Sanderson now is another 250 million, and then a lot of the other facilities are multiple units at one complex. So we've got the Garden Creek complex that has 300 million plus. So it's like kind of on a technicality. Is it the biggest plant or is it the biggest complex of multiple units? So, yeah.
Is Hess going to be 250 at the end of this expansion, or is it going to be larger?
It's going to add 150 to the 250.
Oh, so
yeah.
that's
Yeah.
Okay.
Yeah.
Just curious.
Yeah. Yeah.
Hopefully this isn't too redundant, but are you able to quantify at all the impact of the new ethane Bakken midstream facility, the impact that would put into I guess like the percentage impact that might have on meeting flaring goals once that plant is online?
So the question for those online was to try and quantify that ethane capture and utilization. It's tough to probably put an exact percentage just because we're now dealing with a time frame, several years down the road. But I can certainly say that again, with that chain of events and chain of gas custody that have to be in place, if we did not have all those in place and having solutions for the natural gas liquids, that does constrain the system and puts pressure on gas capture and has the potential to increase the flaring percentages. So it's tough to put an exact percentage just because we still don't have a public number yet of even what the volume is going to be running through that facility. So, yeah.
Any last questions for Justin? All right.
Okay, well, great. Thank you, everyone.
Thank you so much.